So you're watching the market or just watching the daily news doom scroll on your phone, and you're wondering if you have time to make back the money you've lost, but you still want to fund a good retirement, not something where you're constantly pinching pennies and frankly worried about what the market is doing. So what's your best plan? Should you sell your stocks and move into something more secure? Now, it is true. The past year has been difficult. Everyone saw their account values decline. And the reactions have ranged from frustrating to just downright terrified, particularly as we look around and all the news just seems terrible. So it feels like everything, including our investments, are doomed to just keep getting worse. But you really can't just raise the white flag of surrender, play ostrich with your head in the sand. You have to take responsibility for your own retirement savings. Nobody is coming to save you. I personally don't believe either U.S. political party is going to end Social Security or cut benefits for people in or near retirement. But regardless of all that, Social Security is not enough to fund a comfortable retirement, whatever you believe about it. It's not enough. Full stop. So, your investments are crucial to generating retirement income. And if you're in retirement already or very close to it, the money you've accumulated isn't just some abstract number related to some vague future goal. It's what you need to live on now or very close to now. I've worked with a lot of clients as they make that shift into retirement, and even in the best of times, that transition from saving to spending isn't just financial, it's emotional. In times of peak uncertainty like we've been in recently, those emotions run even higher, and we all understand that. But while you may feel a strong urge to sell your stocks, be careful about panic trading. I can't tell you how many people I've worked with who had regrets about selling because a particular news event was very emotional and scared them. Presidential elections are among those emotional events that have caused people to sell stocks in recent years. And that's both parties, by the way. And everybody I've worked with who sold their stocks because they didn't like the president that was elected, they all regretted doing that. But your plan should be determined by your own situation, not politics, not what the market is doing at the moment. Now, here are some things I would like you to consider. First, get a clear understanding of where you stand now and take a careful look at your spending, essential and discretionary, your need for income. In other words, how much will you need to withdraw from your portfolio and for how many years to live a comfortable retirement that you envision, not penny pinching. 2, if you're 55, you're going to need income for more years than your 85-year-old mother. So you've got to keep your time horizon in mind. Super important. 3, your portfolio should address those spending needs according to a plan, not just an emotional hunch or what you read in the news or what some email tells you, one of those stock emails. You should have stocks, bonds, and cash all designed to create the income you'll need when you make withdrawals to fund your retirement. So you do want some cash. To get through a bear market, it's recommended that retirees have enough to cover maybe 2 to 4 years of essential expenses in readily accessible holdings like fixed income and cash. No, I don't mean cash buried in the backyard. What I mean is a money market fund or a cash equivalent. But the problem, of course, is that those don't yield very much, right? It's better than a couple years ago, but over time, bonds simply don't return as much as stocks. But they do provide stability, and plus it can make you feel more secure knowing you have the money you need without being forced to sell in a down market. So I get it. If you're retired, very close to it, you may be more worried about market risk at this point, and all the uncertainty may have you ready to bail out. But don't let your emotions take over. Just like it's not a good idea to time the market as you're getting in, buying stocks at the right time before they go up. And contrary to what you read on the interwebs, that is not a good way to invest your retirement funds. So don't try to time your way out either as you sell. If you want to decrease the risk from stocks, consider gradually scaling out instead of selling all at once. That's actually a pretty common practice for investors in retirement and for those who want to simply reduce their risk tolerance. So to create your rebalancing plan, let's say that your portfolio is currently 75% stocks, 25% bonds, and you want to reallocate that to 50-50, reduce some of that risk a little bit. So it's probably not the best move to immediately just sell 20% of your stocks all at once. Instead, to shift gradually, few things you could do. You could have all your dividends and interest transferred into a bank account rather than reinvesting them. So in other words, that means you're not just simply buying more shares with your dividends and adding to your stock position. You could also sell a percentage of your winners to reap the profits and realize some gains. You could also take advantage of tax loss harvesting by selling some losers, using those losses to offset any taxable gains. And if you have some of those stocks that have just grown like kudzu and have taken over your qualified retirement accounts, like that 30% holding an Apple that just accumulated over the years, or maybe something that just grew because of dividend reinvestments, go ahead and sell them to create some cash for your required minimum distribution if you are near the required age of 73. By doing this periodically, whether it's weekly, monthly, quarterly, or even over different tax years, the interval doesn't really matter. You'll increase your cash holdings in a more balanced way and reduce the potential for regret if the market suddenly changes direction. Now, as you consider moving away from stocks, remember that even in retirement, and that could be a long time these days, stocks should remain an important part of your portfolio. You need that to get some growth. Keeping 20 to 30% in stocks is a way for even the most conservative investor to maintain some opportunity for growth and keep up with inflation. And we've all learned how important that is, right? So while it's smart to have more cash in your older years, a diversified portfolio is a strong hedge against uncertainty, really at any age. When it comes to investing, you never want to think about it as all or nothing. That's one of those emotional decisions again. So if you want some help evaluating your portfolio and understanding whether your investments are right for you, reach out to me at bluemarlinadvisors.com. I'm happy to get on an absolutely free call to see how I can help you achieve your retirement goals. And please don't forget to like and subscribe so I can spread the word to more people just like you who want to be sure that they enjoy their retirement and don't outlive their money. Thanks so much for watching.